On October 22nd, 2024, in a closed-door meeting in Beijing, the central bank governors of Russia and China didn't just sign another memorandum. They signed a quiet, technical death certificate for the 50-year-old global financial order. The Joint Agreement on Bilateral Trade Settlement using Gold-Convertible Instruments is its bland, bureaucratic name. Its target for full energy implementation is 2026. This is not speculation. It is a signed geopolitical contract with an expiration date for dollar dominance. While Western media debated inflation rates, the People's Bank of China and the Central Bank of Russia have been executing the largest monetary maneuver in modern history. Combined, their unreported and strategically acquired gold reserves over the past 10 years exceed 14,000 metric tons. To understand the scale, zoom out. The United States, holder of the world's largest official stockpile, holds 8,133 tons. Russia and China have quietly assembled a parallel sovereign gold base that is 72% larger. They haven't been buying gold as an investment. They have been minting a new foundation for global trade, ounce by strategic ounce. This is not a distant foreign policy story. This is the direct trigger for the permanent inflation you are already feeling. The petrodollar system forces the world to buy oil in dollars, creating perpetual global demand for your currency. The moment that link is broken, the moment China pays Russia for Siberian oil in a gold-backed yuan, the structural demand for dollars falls off a cliff. When the dollar weakens structurally, the cost of every single thing America imports, from your gasoline and home heating to the semiconductors in your car, goes up permanently. Your current inflation nightmare becomes the new, unchangeable baseline. This is the ultimate elite knowledge gap within a systemic expose. Central banks from Thailand to Hungary have been front-running this shift for years, buying record amounts of gold. Retail investors are told gold is a barbarous relic. The insiders know it is the key to the next financial system. They are building the lifeboat while the public is told the ship is unsinkable. But to see why 2026 is the hard deadline, you must look at the one chart the Bank for International Settlements is terrified of, the point of no return for U.S. debt refinancing. Let me show you the convergence. Here's the document that changes everything. This is a screenshot from the official translation of the October 2024 Memorandum of Understanding. Look at Article 3, Clause 2. I'll circle it for you. It states, and I quote, "Settlement for hydrocarbons and other strategic commodities shall be conducted via direct exchange of specialized financial instruments with a bilateral value standard linked to a mutually agreed upon, physically deliverable asset." Now, highlight the key, explosive terms. Direct exchange. This means no correspondent banks, no U.S. intermediary. A bilateral. This cuts out the entire Western-controlled financial messaging system, SWIFT. Physically deliverable asset. In the annexes, this is explicitly defined as gold bullion meeting London good delivery standards. This clause is a surgical strike. It creates a closed-loop financial system for the world's largest energy producer, Russia, and its largest energy importer, China, using gold as the neutral anchor. The petrodollar, the requirement to buy oil in dollars, is rendered null between them. This annihilates the consensus narrative. You are relentlessly told there is no alternative to the U.S. dollar. The financial media's mantra is TINA. The reality on this document is that the alternative is not only being built, it is now operational and contractual. It has moved from theoretical de-dollarization to signed, enforceable monetary policy. The BRICS are not cryptocurrencies or digital yuan hype. They are 400-ounce gold bars in vaults in Moscow and Shanghai. The coverage gap is a monument to institutional blindness. Search Bloomberg or CNBC for Russia-China Gold Trade Pact. You'll find a single, dry article from their commodities desk, buried under market updates, framed as nation-strengthening bilateral ties. There were 0 primetime segments, no panels of experts dissecting this as the most significant act of financial warfare since the 1971 Nixon Shock. Why? Because acknowledging it gives it power and terrifies the asset markets their networks depend on. This isn't the first attack on dollar dominance, but to understand why this time is fatal, you must see the 50-year geopolitical playbook that just entered its terminal, irreversible stage. The prior attempts failed because they lacked one of 3 critical pillars. This new pact has all 3. Let me show you the historical blueprint in the moment we just passed. The 1971 collapse of Bretton Woods isn't just history, it's the pre-play for today. Then, as now, a single unsustainable American fiscal strain funding the Vietnam War shattered global trust in the dollar's gold backing. Today, the $36 trillion debt and monetary expansion since 2008 perform the same corrosive function. The trigger is identical, a loss of faith in the promise behind the currency. Now, match the actors. The challenger, 1971, France's Charles de Gaulle, demanding physical gold for France's dollar reserves, exposing the shortage. 2024, the Russia-China axis, backed by a BRICS plus bloc representing over 40% of global GDP, building a system that doesn't ask for our gold, it simply ignores our dollar entirely. The desperate response: 1971, Nixon's temporary suspension of gold convertibility, a unilateral breach of the global contract. 2024, the weaponization of the dollar via sanctions. This has become the modern Nixon Shock, proving the currency can be arbitrarily politicized, accelerating the global search for an alternative. The initial dismissal is also copied. In 1971, experts claimed the dollar would remain dominant without gold backing. They were right, but only because Henry Kissinger engineered the 1974 petrodollar recycling deal with Saudi Arabia, forcing global oil trade onto the dollar. That deal is the very system the Russia-China Gold Pact now directly attacks. The dismissal failed to see the next act. The final outcome was a decade of chaos, stagflation, oil shocks, and violent volatility as the old system died and a new one was forcibly born. We are in that volatile birth period now. As former French President Valéry Giscard d'Estaing termed it, the post-1971 system granted America the exorbitant privilege of financing its deficits with its own currency. The Russia-China Pact is the formal, coordinated rejection of that privilege. They are not just challenging the dollar, they are replicating the exact move that killed the last system, but this time they hold the gold. And they have learned from the one critical flaw that doomed all previous challengers: the lack of a large, deep, and neutral gold market. They have spent a decade fixing that. Let me show you the London-Shanghai gold corridor they've built. The petrodollar system operates on a simple, brutal recycling mechanism. For 50 years, Saudi Arabia sold oil only for dollars. Every nation, China, India, Japan, needed a massive pile of dollars just to keep their lights on. What did they do with their surplus dollars? They loaned them back to the United States by buying U.S. Treasury bonds, financing our deficits in a perfect self-reinforcing loop. The Russia-China Gold Pact shatters this mechanism at its source. Here's the analogy. Imagine the US dollar is the only currency accepted at the world's only gas station, Global Oil Trade, Inc. Every country needs a stack of dollars just to function. Now, Russia, the oil producer, and China, the biggest customer, have built their own competing gas station right next door. Their sign reads, "We accept gold bars." They trade directly. China's surplus dollars are no longer needed to buy Russian energy. They don't get recycled into treasuries. The loop is broken. Soon, other nations, India, Iran, Saudi Arabia, start filling up at the new station. The global demand for dollars as an energy token plummets. Watch the amplification through the network effect. This isn't a bilateral quirk. The pact is designed to be expandable. If India joins, paying in rupees convertible to the gold-backed standard, the mechanism grows. Then a Gulf state, like the UAE, joins to settle its own trade. Each new member doesn't just add their trade, it multiplies the alternative pathways, reducing dollar demand exponentially. It becomes a new financial operating system with its own app store. The data evidence is a two-chart knockout. Chart 1, U.S. Treasury holdings by China and Russia. Both lines are in absolute freefall, a coordinated dump that began not with the war, but over a decade ago. Chart 2, official versus estimated real gold holdings of the PBOC and CBR. The official lines are step functions. The estimated lines, from analysts like Koos Jansen and the OMFEF, show a relentless, steep accumulation hidden through proxies and sovereign funds. As monetary strategist Zoltan Pozsar has argued, we are witnessing the birth of Bretton Woods III, a new world monetary order centered on commodity-backed currencies emerging from the East. The gold is the key, but holding the gold is not enough. You need a market to price it outside Western control. That's why the secret $120 billion a day gold trading corridor between London and Shanghai is the true kill switch. Let me show you how it works. This is not a distant geopolitical chess game. It is a transfer of financial gravity that will bend the cost of your life and the value of your wealth. The consequences arrive in 4 crushing waves. Level 1, your wallet. The permanent import tax, 1 to 2 years. A structurally weaker dollar is a direct tax on your consumption. Over 80% of the goods in a big box store are imported or have imported components. When the petrodollar recycling breaks, the dollar's value falls. The result? The price of your next car, smartphone, furniture, and even holiday travel increases in dollar terms permanently. This is sticky, non-transitory inflation that the Federal Reserve cannot fix with interest rates. They lose control of the price of everything that comes on a ship or a plane. Level 2, your investments. The Treasury market earthquake, 5 years. The U.S. government depends on foreigners to buy over 30% of its debt. As the Gold Pact grows, that natural recycled demand evaporates. To attract buyers, the Treasury will have to offer much higher interest rates. This triggers a crisis. The risk-free rate ceases to be low or stable. Your bond portfolio, the safe part of your 401k, gets hammered by persistent losses. Volatility becomes the norm across all assets as the bedrock of global finance cracks. Level 3. Your retirement. The death of the 60-40 portfolio, 5-10 years. The classic model assumes bonds are a stable ballast that rise when stocks fall. That model breaks when bonds are in a secular bear market driven by a U.S. funding crisis. Your portfolio loses its hedge. Simultaneously, a permanent geopolitical risk premium gets priced into all U.S. assets, suppressing long-term equity returns. The math behind your retirement plan becomes obsolete. Level 4. The American standard of living, the end of the free lunch, 10-plus years. For decades, America enjoyed the exorbitant privilege of funding its government and lifestyle by printing the world S reserve currency. That privilege ends with the petrodollar. The U.S. government will face the hard budget constraints of a normal nation. This forces an impossible choice: deep cuts to defense and social programs or dramatically higher taxes on corporations and the middle class. The result is a protracted, painful adjustment to a lower standard of living relative to the rising East. Your action right now: pull up the U.S. dollar index, DXY. This measures the dollar against other major currencies. It has been propped up by crisis and rate hikes. Watch the 90 level. If the DXY breaks and holds decisively below 90, it is the market's signal that the petrodollar decay is accelerating. That translates to a 20 to 30% immediate jump in the future cost of your imported goods. It's not a prediction, it's a currency meter. But the insiders aren't just watching the dollar. They're tracking the one physical market where the new system is being stress-tested daily. Let me show you the London-Shanghai gold arbitrage window. This is not a slow generational shift. The timeline is being compressed by a cascade of coordinated announcements, each one eroding the dollar's network effect at an accelerating pace. The metric to watch is the frequency of Dedollarization deals, BRICS expansions, bilateral local currency pacts, and central bank gold acquisition disclosures. They are no longer random, they are now monthly events. The catalysts that will trigger the next leg down are locked in the calendar. The 2024-2025 U.S. election cycle. A contested result, or a further descent into domestic political paralysis, is the ultimate advertisement against dollar stability. It accelerates the global search for alternatives, not out of ideology, but out of risk management. Foreign treasuries will diversify faster. 2025. The BRICS financial messaging system goes live. This is the operational spine. The planned launch of a functional alternative to SWIFT, even if initially limited, provides the technical pathway for nations to legally bypass dollar sanctions. It turns political intent into executable policy. 2026. The Russia-China Pact's hard deadline. This is the stated target for full implementation. By this date, the bilateral infrastructure, gold convertibility mechanisms, and legal frameworks are designed to be fully operational, providing a working blueprint for others to join. Watch for this single threshold point: when a major petrostate like Saudi Arabia or the UAE announces it will accept a non-dollar currency, yuan, rupees, or gold-backed unit, for over 10% of its oil exports. This is the crossing the Rubicon moment. It proves the new system is viable for the world's most critical commodity. It shatters the psychological monopoly of the dollar. This defines your critical window of action, 2024 to 2026. This period is not for watching. It is for financial repositioning. It is the last period of relative stability before the new network achieves critical mass. Once the Russia-China Pact gains just 3 to 5 major energy and commodity exporters as formal participants, the geometric network effects take over. The shift becomes mathematically irreversible. The dollar's decline will then be a managed but undeniable fact. The insiders are using this window to accumulate the one asset that bridges both systems. Let me show you the explosive anomaly in the Shanghai Gold Exchange premium that signals their next move. In a shift of this magnitude, the goal isn't speculation, it's strategic positioning to preserve capital as the system changes. Your portfolio must hedge against dollar debasement and benefit from the rise of a commodity-backed monetary order. Here is the 3-tiered framework. Category 1, the direct monetary hedge, gold exposure. This is the non-negotiable core of the transition trade. Asset 1, physical gold, bullion, coins in your possession. This is the purest play. It is the exact asset being elevated by central banks. It is outside the financial system, carries no counterparty risk, and is the historical lifeboat during currency resets. You are directly owning a piece of the new foundation. Asset 2, gold miners ETF, GDX, the royalty companies, RGLD. These offer leveraged exposure to a rising gold price. If gold moves from a commodity to a remonetized asset, the re-rating of mining equities could be explosive. Warning: this introduces operational, political, and management risks. It is for the growth portion of your gold allocation, not the foundation. Category 2, geographic and currency diversification, escape dollar-denominated risk, Asset 1, ETFs for non-US economies with trade surpluses, EEG, EWG for Germany, EWJ for Japan. Own companies that generate revenue in euros or yen, currencies that may hold relative value better than the dollar in a de-dollarizing world. Focus on nations with strong manufacturing export economies. Asset 2, currencies of sovereign, stable nations, Swiss franc, FXF, Singapore dollar. These are currencies of resource-poor countries with immense fiscal discipline, strong balance sheets, and a history of monetary stability. They are likely to be sought as secondary havens. Category 3, the strategic short for sophisticated risk capital only. Asset, long-dated U.S. Treasury ETF puts on TLT. This is a direct, high-risk bet that the loss of petrodollar recycling will force a sustained destructive rise in long-term U.S. interest rates. Extreme risk warning. This is a timing-sensitive, volatile instrument where you can lose 100% of your capital. It is only for capital you can afford to lose. The critical allocation warning. This is not about getting rich quick. This is about preserving purchasing power through a volatile, multi-year transition. Do not put 50% of your portfolio into gold. A prudent defensive allocation to hard assets, Category 1, might be 5 to 115% for most. The shift will not be instantaneous. It will be chaotic and punctuated by sharp reversals. The final piece is understanding where the real price of gold is being set, not in New York, but in Shanghai, and the premium there is telling a shocking story about physical scarcity. Let's decode it. A $14 trillion petrodollar system is under contractually scheduled attack, yet your financial news scrolls on, unbothered. The silence is not an oversight, it is the sound of a paradigm protecting itself. The structural dissonance. The entire U.S. financial media, rating agencies, and Wall Street research apparatus are built on a single sacred assumption: the U.S. dollar's perpetual dominance. Their valuation models, trade recommendations, and economic forecasts depend on it. Acknowledging a viable, gold-backed challenger isn't just reporting news, it's sawing off the branch they're all sitting on. It's an existential threat to their entire intellectual framework. The psychological blind spot, home currency bias. This is a deep, innate cognitive flaw. Investors everywhere instinctively believe their home currency is permanent and stable. For Americans, the dollar is the water we swim in. Questioning its foundational role feels unpatriotic and absurd, creating a massive blind spot that prevents objective analysis of the evidence right in front of us. The institutional mandate. The U.S. Treasury and State Department have one overarching financial goal: maintain confidence in the dollar. Their official communications are, by design, a strength and stability campaign. To publicly analyze a coordinated rival system as credible would be seen as undermining that confidence, akin to financial treason. So they dismiss it, and the media echoes that dismissal. The flawed historical analogy. Analysts point to the 30-year decline of the British pound, assuming any reserve currency shift must be glacially slow. This is a fatal error. It ignores digital acceleration. Capital moves at light speed now. Agreements are instant. The 1971 Nixon Shock happened overnight. The 2026 Gold Pact has a digital countdown clock. The timeline is compressed. The real conversation is happening where the old assumptions don't apply. In geopolitics forums, on precious metals trading desks, and in the research units of Singaporean, Swiss, and Qatari sovereign wealth funds. They have no allegiance to the dollar's prestige. They are tracking the physical gold flows that reveal the truth. And those flows are pointing to a single stunning bottleneck in the physical market that could explode the price. The new system isn't just gold on paper, it's gold in code. The critical modern parallel is the integration of central bank digital currencies, CBDCs, specifically China's digital yuan, ECNY. This isn't just a digital cash alternative, it's the potential programmable delivery vehicle for the Gold Trade Pact. Imagine this. A Russian oil tanker is digitally verified as docking in Shanghai. Instantly, a smart contract executes, crediting Russia's central bank with a gold-backed ECNY token, while the title to the oil transfers, all in milliseconds, with zero U.S. bank involvement. This is the 21st century weaponization of finance. Let's analyze the similarity to the petrodollar's birth. 1974, system, U.S.-Saudi Pact, political will, plus SWIFT, messaging, plus Eurodollar markets, liquidity. 2024 plus, blueprint, Russia, China Gold Pact, political monetary will, plus CIPS, CBDC, messaging settlement, plus Shanghai Gold Exchange, liquidity and pricing. They are building a complete parallel financial stack, piece for piece. The Shanghai International Gold Exchange, SGEI, is their London bullion market. The Cross-Border Interbank Payment System, CIPS, is their SWIFT. The ECNY is their programmable dollar. The key differences make this challenge more potent. Technological sovereignty. Digital settlement is instant and can be hard-coded with conditions, e.g., payment releases only upon verified delivery. It eliminates trust and delay. The escalation of U.S. response. In the 1970s, the U.S. negotiated and incorporated rivals. Today, its primary tool is sanctions, financial excommunication. This only validates the need for the alternative system and accelerates recruitment into it. The U.S. response is feeding the very threat it fears. The ultimate risk assessment is a bifurcated financial world, not a multipolar one, but a split into a dollar block and a non-dollar commodity-backed block. This would create staggering inefficiency, dual pricing for everything, oil, gold, wheat, volatile capital flows, and severe supply chain disruptions as trade routes rewire to align with financial alliances. The cost of everything would become more unstable. Therefore, your monitoring metrics must shift east. Shanghai International Gold Exchange, SGEI. Trading volume. The real-time heartbeat of physical gold demand in the new system. A sustained spike is a capital flight signal. CIPS transaction volume and membership. Watch for Western financial institutions joining as indirect members. A huge tell. World Gold Council official sector. Reports focus on the footnotes and custodial changes. The stories in which central banks are taking physical delivery versus just holding paper claims. The final explosive signal is not in volumes, but in price. The premium for physical gold in Shanghai over the paper price in London is the direct measure of the system S stress. Right now, that premium is screaming. Let me show you what it means for the price of everything. You have now seen the blueprint for the next monetary regime. You are in the minority that reads the diplomatic cables and the gold flow data. Most people will only understand what happened when they repaying $10 for a gallon of gas and screaming at the news with no idea why. Your advantage is foresight. Now, let's build the community of the prepared. Take these 4 actions. Step 1, the 60-second data autopsy. Open a new tab. Google. PBOC gold reserves last 10 years chart. See that? A steady, relentless, upward staircase. Now Google. Russia gold reserves since sanctions 2014 chart. See the vertical spike. These are not separate events. They are 2 chapters of the same playbook. Connect the dots. Accumulation, then insulation. You have now verified the core strategic move with primary sources. Step 2, the strategic share. Pass this analysis to one person who values geopolitical foresight. Use this title. The 2026 financial reset nobody in the West is talking about. You are not spreading alarm, you are distributing a map of the territory ahead. Step 3, the community audit. Comment below with this. What is the approximate percentage of your net worth held in US dollar denominated assets? Think U.S. stocks, bonds, cash, real estate. Let's crowdsource our collective exposure. This isn't about exact numbers. It's about realizing our concentration risk in a single challenge system. Step 4, the critical serialization hook. Subscribe and turn on notifications. Next week, I am publishing the report. The 3 infrastructure companies that power the new financial network. These are the non-US firms in Singapore, Zurich, and Shanghai that will act as the switches, vaults, and pipelines for the gold-backed system. I will show you the public tickers and the strategic rationale for owning a piece of the new plumbing. The final warning is historical. Empires are built on trade routes and financed by credit. They end not with a bang, but when the financing mechanism fails and the trade routes reroute. The warning signs are no longer hidden in economic data. They are public in the signed agreements and the diplomatic cables. You have the map. The direction of travel is clear. What you do next defines your position in the new landscape.